Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me today is Lenore Hawkins of Tematica Research. Lenore, thanks so much for coming on again.
Hi, thanks for having me.
All right, so you've been coming on for, about a year now, but the last 6 months, we have started every episode with an update of what your life is like in Italy. I don't see any reason why we should change that cadence here today. What's life like in your world in Northern Italy?
So it's actually really interesting. As of July 1st, and remember that Italy had probably one of the most draconian lockdowns of any country because we were the hardest hit. And I'm, lucky me, right in the epicenter of what was the worst part of Italy. I mean, at this point, Italy's like totally passé. I think we're like number 10 on the list of most affected countries. But there was a time where Italy was the worst, most affected. So people here, it hit people emotionally pretty hard. As of July 1st, we didn't even have to wear face masks outside. Now, you still have to wear them if you're in enclosed spaces. You have to wear them if you're going to be like standing in a line, even if it's outside. But if you're in a line where you're close to other people, you need to wear one. And yet, if I go outside, pretty much everyone is wearing a face mask except for the tourists. So they pretty much stand out. We don't really have hardly any tourists compared to what we normally have. I'm just north of Milan in Lake Como. And Lake Como, as you can imagine, I mean, it's just usually a mass of tourists. Right now, we really only have a tiny fraction of what we normally have. And they're primarily like Germans, the French, people from other parts of Europe that can drive here because the European Union has opened up its inter-borders. So within the European Union, people are free to travel around, which is big because for a while there, every country was like, no, you cannot. Right. I mean, we had people that I work with who were just like literally 20 minutes from here over the Swiss border, stuck there for like a month and a half because they're just not allowed to come across. And if they really pushed because they were Italian residents, they would have to be quarantined for extended period. And it just was not something doable work-wise. But things here have definitely gotten a lot better. When next we speak, I will be letting you know what it's like to travel internationally because I'm actually going to leave here tomorrow, fly to Dublin, which is going to take me an unbelievable amount of time because you can't fly there directly. I have to spend 5 hours in London Heathrow, then fly from Dublin to the States next Sunday. So see how that goes and have my coronavirus test all scheduled for right after I land.
And that's your first time back in the States in 6 months, right?
Yeah, it is. It's it'll be weird to be back there. So this is the longest I've been out of the US ever in my life. So I'm looking forward to getting back.
I'm curious about the tourists in Milan. Yeah. Like what are they doing? Are exhibits open? Are museums open? Or is it the vacation folks?
More vacation. So if you go into Milan, there's hardly anyone there because things are still really shut down there. I mean, you see some people in parts, but it's still, I mean, I've never really seen Milan the way it is right now. Where I am in Lake Como, it's a little different, I think a little bit easier for tourists because there's tons of villas around here that you can rent, like the Ubers and all that, where you can take the whole family and stay for a week and really minimize, like you're not having to go out to restaurants as much. And we also, because it is so tourist oriented, there's tons of outdoor restaurants. So it's easier for people to stay outside. They're saying like ultraviolet's really good, being outdoors with a breeze. It's a lake. There's always kind of a breeze. So I think it's probably minimal risk, but I think people are just here to just kind of relax and try to not be home. I mean, who isn't sick of being locked down at home?
Right. So we're recording this on July 6th. This past weekend, my family tried to find a place. I'm in Atlanta, Georgia. Tried to find a place to get away for the weekend. We looked in the panhandle of Florida, along the coast with Georgia and South Carolina, the lakes in the area.
Yeah.
Everything was booked. People were just ready to get away because they've been locked up for so long. But interestingly, we have noticed that people are starting to wear masks more here in Georgia. And Georgia's more of a, they were ahead of the curve opening up. They've been a little more aggressive in what they've allowed. And we noticed we would go to the grocery store sometimes and there would be no masks. And now it's starting to pick back up. People are taking it seriously. And, let's use that into a pivot and how you see this and the economy unfolding here as we enter the third quarter.
What's funny, who would have thought that masks would become like the big heated debate of 2020? And it really is key to the economy, in that if you're wearing just a plain old mask, as we know, like it's not necessarily going to really protect you a ton, just a regular one, if not the surgical, like N95s and all that.
Right.
But it does protect other people from you. And if everyone does that, everyone's protecting to at least some degree everyone else, and the cases really can come down. And I think that's one of the reasons. And there's actually quite a bit of scientific study has been done on how Italy went from spiking so high to, now we have maybe a couple hundred cases, like 100, 200 cases a day. That's about it. And it's because people are being pretty good about wearing the masks. At least that's what the data says. And that's anecdotally, I could say, looking around, people seem to take that quite seriously. That, and like you said, the hand sanitizers, you go into a shop, very few people are allowed in at a time. You still have to do the hand sanitizers. And even in the grocery store, you walk in, you first have to put gloves on. Like they literally hand you gloves and they watch you. And if you try to take those things off, which is really hard to like pick up sticky things.
I'm sorry, Lenore, let me make sure I understood that. Mandatory gloves when you walk into a grocery store? Are these disposable gloves that you're putting on, you do your shopping, and then you take them off?
Yeah.
Wow.
And they're very careful about only allowing a few people in at a time. So it does seem to work. I mean, we've kept it down. We'll see what happens with the tourism, because what we have here is sort of a bit, things have been so much tighter than the US. Now we're starting to allow tourism in. Now we'll see, is that going to mean cases are going up? But for the US, it looked like on the data that we have seen so far, and most of this data, though, unfortunately, it's before those cases started spiking up again. But if we look at this first chart, it looks like the US economy has probably bottomed out. But as we're talking about with these cases spiking up, the recovery is not going to be a smooth one. So this chart here looks at the leading to coincident ratio of indicators, and that tracks the relationship between those leading indicators like permits, right? You would get a building permit before you would build, so that would be more indicative of like forward-looking in the economy, versus coincident indicators, which are things like industrial production or employment. Now, when you get towards the end of a recession, you usually see the leading indicators turn up first, right? Those ones that are more forward-looking. So your leading indicators look a lot better than your current indicators. So this is giving us a impression, this chart, that we're maybe out of the woods. But I would caution that this is also based on data that is pre this new spike in the cases, and we don't really know how much economies in the US are gonna lock down again, or even if they don't actually lock down, that's a politically heated discussion.
Right.
People can end up being locked down de facto of their own choice. For example, in Sweden, where they had no real lockdown, their economy got hit pretty hard. I mean, nearly as hard as their neighbors that did actually do the lockdown, just because people looked around and said, you know what, it's not worth it to me. I'm going to go out of the house as little as possible. Although clearly that's not what we're seeing in the US so far.
Clearly.
Yeah, clearly. So if we look at the second chart now, this tells you what's really going on in the US. So we heard this great news about the jobs report, right? Well, the reality is that the labor force participation, so that means the portion of Americans that are actually at the age to be working, that labor force participation rate is down where it was nearly 50 years ago. I mean, that's how many people have just said, I quit, I'm out, I give up. And if we look at the next chart, that shows you that this isn't just the old guys, right? This isn't just the boomers, the senior citizens that are deciding to step out of the workforce. It's actually pretty much across the board. And it's skewing, unfortunately, even a little bit more towards the younger. Because you can see in this chart, you have, there's a little dip in the 55 and older crowd as far as labor force participation, but it's only a little one. So this tells us that you're seeing an awful lot of the younger, and anecdotally, we also know that's true when we go and look at what kinds of jobs are actually the ones being lost.
I mean, that makes sense, right? The restaurants, the service workers, the people that couldn't open up generally had younger folks, right?
Exactly. This next chart, that actually points out what retail sales are looking like. And if you're not having people coming into your shop, you don't really need that much staff. Or if you're completely shut down, right? You don't need to have staff coming in. I mean, this chart just is amazing to me. That's showing that retail sales are back at 2014 levels. I mean, that is just a complete bottoming out. And these sales, it's not, we keep talking about this V-shaped recovery. Well, that depends on how you're charting it. These are sales, not all of these sales are going to come back, right? So if you're a retail shop owner, a lot of your sales, they're just done. You've missed a month or 2 months. Maybe you'll get a bump up in the coming months, but you're not going to recoup all of that.
Especially if you're selling food or alcohol, if you're a bar, you're not getting any of that back.
Right, exactly. You're not getting it back. And if we want to kind of look at the big picture of the economy, you can see like electricity usage is down almost 3% year over year. Lumber production is down almost 6%. If you look at railway car loadings, and that measures like how much stuff that we're moving around so that people can buy it, that's down about 15%. So that's the stuff that's getting moved around to buy and sell is down 15%. Steel production is down 33%, right? So that's all telling me that things are still really, really slow. So I think if we skip on over, we'll skip that last one, go to maybe chart. Yeah, this one's just showing capacity utilization. So for all those people who are looking at the Fed and saying, oh my God, we're going to have really big inflation, this capacity utilization, that's our ability to make stuff. You could see it just completely tanked, which it usually does when you hit a recession. All the shaded areas, those are recessions. It did it again. But look at how it's been year after year after year. It's kind of been trending down over the long haul. And this is really bottoming out. It's very difficult to have inflation when you have a lot of excess capacity, a lot of excess ability to make stuff, right? Because you have a spike overall. You have that inflation pushing up prices when there's demand and you can't really fulfill the demand. If the demand goes up and you still have plenty of room to make the stuff people want, prices tend to not go up as much.
So Lenore, I tend to struggle with the best indicators to monitor inflation. I don't trust CPI because of all the massaging that can happen. Gold by itself can be challenging because that can be manipulated through the futures markets. What do you use? And more importantly, what should financial advisors use who are building portfolios that do want to have a good inflation hedge or a tool for monitoring it?
Well, that's a great question, because I hate the word inflation in that it gets tossed around as if we're all talking about the same thing. Right. And it can mean very, very different things. I tend to go a little bit more on the classical definition of inflation, which just means across the board, prices are all moving up so that you have a real degradation in the purchasing power for a particular currency. Because you can also look at, cross currencies, like the Big Mac indicator, right? What's how much does it cost to buy a Big Mac in different currencies? So if we're talking about just the purchasing power of the US dollar for domestic products, I look at a big range of them. I will look at CPI and core CPI. I also like the million products. There's a MIT students did this million prices project.
That's right. Yep.
I love that one, right? Because it's a huge spread of all kinds of things that consumers buy. So if you're looking at hedging a portfolio against inflation, one of the things to be thinking of is, well, what aspect of inflation are you looking to really protect against? Because are you talking about senior citizens and that they're maybe looking to retire and they're going to have this fixed income? That's a very different kind of portfolio protection than if you have some new clients that have just joined that are in their 30s, and if prices are going up, if the purchasing power of the dollar is going down, then their wages are going to be going up kind of in lockstep with it. So you would have a different way of looking at that. As far as the risks of inflation, so one, we looked at that capacity utilization, but also it is going to be really, really tough in the near to medium term, I think, to get inflation going, given the massive amount of debt that we have across all aspects of the economy, both particularly at the government level, but also at the corporate level, because that enormous level of debt is such a huge headwind to growth. So it's really hard to get the economy to get heated up. So I think eventually we can have a problem more because of the currency. And that's a different kind of a driver. Like when you're talking about inflation, you want to say, well, what is it that's really driving prices to go up, right? So in like the 70s, we saw that huge spike in inflation that was really more about baby boomers moving into the prime purchasing age. So you had this huge spike in demand. If we're talking about like trying to get that going now with the money supply, it's really tough when there's so much debt. Corporations were already burdened with the heaviest level of debt we've ever seen in history. And then the pandemic hit and everybody had to borrow even more money to just tread water, right? So that's going to be difficult. We could see something, but it's years away. That could happen with the US dollar becoming very weak versus other currencies, particularly if it comes into question about the US dollar remaining the global reserve currency. That could be very problematic for the strength of the dollar. And that would be a different thing if we saw that the dollar was depreciating against everything else, other currencies, and that would mean our imports would become more expensive.
Right. Like you, I find defining it to be a challenge. I feel that in the 1970s when we came off the gold standard, that was more of a currency issue along with the oil crisis that happened. But as I look at, the real world for us, the last 20 years, anything that requires debt, like colleges or housing, sees inflation, or anything that the government moves into, like healthcare, sees inflation.
And like housing and education. Right? Because the government decided that it was really good for everyone to own a home. So they kept making it cheaper and cheaper, easier and easier to buy a home, as far as easier to get the debt. Right? So we had this explosion in debt for home ownership, and surprise, you had the home demand for homes go skyrocketing, which is actually one of the great things to see here, is that home production has really been very muted compared to recent decades. So we're not seeing any problems in the home prices, anything material like we did back then. So I really don't think we're going to see a housing crisis with this recession. Little dips here and there, but much more the normal kind of fluctuations that we used to see. That is, of course, barring this pandemic getting a million times worse than we imagined, which we still don't really know. A lot of uncertainty still.
Tell you what we're seeing here in Atlanta, and I've heard about this in other major cities in the Southeast, just where I have friends that live, is the suburban house prices are going through the roof.
Yes.
There are houses bought in my neighborhood, sight unseen, well above ask, from people moving either from the city of Atlanta out or from the Northeast down. But there was this whole dynamic over the last 2 decades, well, really since 2000,
urbanization,
where the city's exploded. I mean, downtown Atlanta, downtown Nashville, downtown Charlotte have all these condo towers. They're just beautiful. But now you got to wonder if there's going to be enough demand for them as people are trying to move outside of the cities, coinciding with the millennials realizing, hey, maybe I don't want to raise my families inside the city, and they start moving out.
And it'd be interesting to see how long that goes, because if we were to, and this is kind of when we look at going forward, what are the risks on the economy and on the markets? If we were to get a vaccine that's really effective quickly, if for example, I think it's the AstraZeneca one that's showing a lot of promise, if we get one of those and it's be able to produce it very quickly, and this whole virus and if that other virus that they're now talking about, there's a swine flu one that's, come on, I mean, 2020, you are like the meanest year in my life.
That's right.
If that all kind of goes away and then this was just some bad memory, it'd be interesting to see if that shift continues. I do think that no matter what, we will continue to see a shift in the way people work, because no matter what, companies are going to have a lot more headwinds going forward for growth. And so they're going to be looking for ways to cut costs. And a great way to cut costs is to look at where your people work, how much you're putting in your fixed overhead. Can you reduce your physical space? Can you maybe possibly pay people a little bit less because you're letting them work wherever they want, and maybe their cost of living is lower, right? If you're not working in Silicon Valley, instead you're working in some really beautiful area where the cost of living is very low, then you can pay them less, and then just have them come in, say once a month or quarter or something like that.
Yeah. Yep. All right. I didn't mean to get you off track on inflation.
Worries.
It's just something that's fascinating to me because, somebody who builds portfolios, you have to account for it.
Yes.
But having those conversations, especially with the end clients, can be a bit of a challenge.
Yeah, you really have to look at you have to think about what it is what aspect it is that you're trying to protect against, right? I think that makes it, instead of just the inflation word, which can mean so many things.
That's right. But I got you off track. You did send over a chart on recessions and employment.
Yeah. So one of the things everybody was on Thursday was, the jobs report came in for June so much better than expected. It did, but we have to think about what kinds of jobs these are and also when the data was being pulled. So that jobs report, good surprise that we added 4.8 million jobs versus the 3.2 million expected. But those jobs were mostly in the sectors that have been hardest hit. And those are those jobs that are also the easiest to get rid of and to bring back. They're in the restaurants and retails and all that. And so far, we've seen about half of the losses from March and April in retail and restaurants and so on have been returned. And that does look really good kind of surface-wise. But if you look into the details of what's been going on with restaurant reservations and retail, I'm not confident that kind of rehiring is going to be supported, particularly when if we go to the next chart, if we look at what's going on with the coronavirus cases. Because the data last week reported that actually came from the point where the coronaviruses, the new cases were actually getting as low as they had recently. So see this dip, that's when they did the survey for the June report. Mm-hmm. Since then, things have dramatically changed, right? And now we're talking about maybe returning to lockdowns or people just getting scared. And you don't have to have an official lockdown. You have a de facto. In fact, more than 75% of all the jobs that have been added since April have been in leisure, hospitality, retail, personal services, like dentistry, those kinds of things. Those industries, if we look at what's going on with the coronavirus now, the coronavirus cases, I don't see those industries growing dramatically in July and August. If hospitalizations continue to kick up the way they are, if the mortality rates are continuing to be so shocking, that's probably not going to continue to grow. So next month's employment report could look very different. And then on top of that, state and local governments have had to slash employment because they've been deprived of tax revenue, right? You're not getting tax revenue of all the shops. The restaurants are all closed. And if people have had to lay off, right, you're also not getting any of the employment tax stuff. So we've seen about 1.5 million jobs that have been lost in government, and those aren't coming back anytime soon. So the fact is really that if we exclude those super high risk sectors where the employment can very quickly be cut again, and we also kind of cut off construction, employment's actually been fairly flat since April. So that's not a particularly good sign.
That's not a V, Lenore. That's not.
Yeah, that's not. I'm not feeling the V. So if we look at the next chart, at chart 5, that shows like we've hit now the U.S. We're nearing 3 million confirmed cases. We've had over 130,000 deaths, and in the first 4 months of July, more than 12 states saw record high daily new cases. Houston, Texas is saying that it's going to run out of hospital beds in 2 weeks. Arizona is seeing about 25% of the tests are coming back positive, and its ICUs are about 90% of capacity. And now we've got governors in at least 20 states are mandating the masks. Now, from somebody who lived through the pandemic, kind of the epicenter of it in Europe, when you start seeing this, and who knows, every country is a little bit different, but that's where things start to get really scary. It was astounding to me to live through it here, how quickly we went from, it's not a big deal, to utter terror. Mm-hmm. And it was driven by the hospitals. It was when you heard on the news, there's no more hospital beds left. That's when people started really panicking. And that could be what parts of the US are in store for. I think we have to be very careful here about speaking about the US in aggregate because it is enormous. A lot of people, we got to look at much more focused areas, but it's still, if you turn on the TV and you see, for me, like I'm in San Diego and I see that Los Angeles is running out of hospital beds, it may affect our decisions there as well. So if we move on to the next chart, looking at
this chart, to make sure we're on the same page, this is
Yeah.
your chart about seated diners.
Yeah.
Compared to
all
the
the
previous week,
closings.
which is really interesting. At least I've noticed in Georgia, the restaurants are packed. I mean, there's a wait to get in anywhere. So I imagine that might
let's see how long that lasts.
It might end up trending more along these lines here.
Yeah, if people start realizing that this thing really it is really contagious, and you really do get very sick, and you might decide to, even though the weather's nice, you might want to stay home. So the markets are amazing right now. They have become, the equity markets have become completely untethered, both to the economy and any news on the pandemic. We're really at kind of a mania phase. And you could see kind of evidence of that around this morning on the front page edition of the China Security Times. There was all of these efforts talking about how, now's the time to get into the stock market. The boom is going on. You don't want to miss it. The government's really pushing to try and get more and more people to pile in. They've actually been putting more efforts into bolstering equity prices than that they are doing fighting the coronavirus. In the U.S., last Thursday was the 100th day since the S&P 500 bottomed out when it had dropped 33%. And since then, its gains have been the strongest 100-day performance in 80 years.
Makes
the
sense.
NASDAQ, strongest, 80 years, right? Which makes no sense when you think about how much we do not know. I'm not saying that makes no sense because of what we know. It's because of what we don't know. We do not know how long we're going to be dealing with this. We do not know how long the economy is going to have to be constrained and to what degree it's going to be constrained. And yet we're making new all-time highs. And we've seen now the NASDAQ 100, the very tech-heavy, its relative performance versus the S&P has passed the 2000 peak that it hit right when the market, right before the dot-com boom bust crashed. Today, the S&P is only about 7.6% below its all-time high. And this is a terrible market. This is a terrible timing metric. So never use this for timing, but it does tell you about the future returns potential. The S&P right now is 130% of GDP. Now that has passed a prior peak from March of 2000, which for those who were in the market then, that March of 2000 was this peak, and the NASDAQ, it took forever. I mean, the markets just crash. It took the NASDAQ more than 10 years to recover. That market peak was for the S&P was 127% of GDP, and today we've hit 130%. So valuations are extremely, extremely stretched. And as I was saying, this is sort of crazy when you look at the underlying realities. We've had U.S. investment grade companies have issued a record $840 billion in debt in just the first half of this year. Now that's 2 times the prior record we've ever seen in a half of a year. Now the last time, or the prior record was in 2016. So this year we've seen double that. And that's at a time when we're facing an economic contraction on a global basis that is unlike anything we've seen in 100 years. Non-investment grade issued $180 billion, which is also a record. And that's happening when the non-investment grade default has risen from 4.4% to 6.4%, a 10-year high. So default rates are going up, more and more debt is getting issued, and equities are just shooting the moon.
So the cynic says, all that matters is how much debt will the Fed print. Beginning of the crisis, $10 trillion. It doesn't matter which party is in control. Fed is $8 to $10 trillion this time. They have committed to buying U.S. equities. You have to take that in consideration when you're building portfolios. It's almost as though they're saying the stock market cannot go down.
You just need to know, so it's not, the market is not going up because there's anything fundamentally right. Like all the fundamentals are very, very dark, but the momentum is there, and the narrative, the prevailing narrative is the Fed has your back, and they really do have to, because if you look at tax receipts for the federal government, if they don't get cap gains tax, that federal deficit is going to look a whole lot worse, and it's already really, really bad. So this game of musical chairs really has to keep going, but keep that in mind when you're looking at the market, that is what's really propelling this. It is not the economic fundamentals, because that you'll miss the turning points if you're looking at the fundamentals. Coming into this year, we can see on this chart, the US was already had a really bad situation with the supply and the demand of US treasuries, right? So from even in up through 2014, you had where a lot of the treasuries being issued were being purchased by international buyers, and that all started to change in 2014. So what that means right now is that the Fed and their proxies, the US banking system, are really going to have to keep buying enough of those treasuries out, and that's putting dollars out into the system. They have to keep doing that to keep funding the national debt, and that means tons and tons of liquidity. And as that liquidity goes up, that keeps pushing the asset prices up. And if they stop doing that, that means asset prices are really going to come under a lot of pressure. So if we go to the final slide, so here's what to be looking for when we look at the big picture of the market. You've got, like we were saying, the market, the momentum is there. The Fed has everyone convinced it's got your back. So if we're looking at the downside risks, right now we're facing extreme valuations. For example, the tech sector accounts for around 30% of the S&P 500 right now. That is the highest level we've seen since, again, the dot-com bubble. The S&P 500 is trading around 22 times 12 months trailing, versus there's 36 times for the big five, you know, the Amazon, the big five tech guys, and just 19 for the S&P 500, right? So if for the median S&P 500, so there's a lot of concentration in those valuations. So those extreme valuations, it's always risky when you're buying when valuations are already really high. So know that you're doing it because if it's a momentum play. The Cold War with China, you know, comes in and out of the headlines. There was back in December when we were talking about this phase one trade deal that could move the markets dramatically. Now the market's not even paying attention to the trade war, but that really could come back in. And we're seeing where so far China is not able to, or choosing not to, live up to the terms of the trade one agreement so far, what it said it was going to buy this year. Downside risk also, looking at the pandemic, it could get a lot worse than we were expecting. And we could see a huge wave of insolvencies. About 20% of American businesses are expected to never come back. And those insolvencies are only going to accelerate what we're seeing in terms of credit with the banks, where people are paying down their credits. Banks aren't lending to people or to businesses anywhere near where you would be hoping they were. We've already seen lending has been cut by about 15.5% annual rate. That's an extreme cut. Another risk is the election, 2020 election. Biden versus Trump, that's going to mean different things for the market. And 6 months ago, it looked like it was definitely going to be Trump. Now it's looking more like it could be Biden. And that has to be factored into when you're looking at portfolios, how that's going to affect the markets. And in reality, when you look at this market and people talking about the V-shape, before all of this started, the Fed was forced to keep rates insanely low. And even though it was keeping rates insanely low, the market was barely treading water. It was the weakest growth we've ever seen in an economy. And the only net buyer of stocks were corporations themselves through share buybacks. And they are now going to be out of the system. And on top of that, as we move towards the end of the year, we're not going to have employment be then where it was at the beginning of the year. So think about all those 401ks, all those bonuses that are not going to get paid. So those are more people who are not going to be participating and able to buy into the stock market. So keep that in mind when you're thinking about what's kind of the liquidity, the equity flows. On the other side, the upside risks, the Fed just may be able to pull this off for a while longer, right? I mean, we all know at some point the Fed's not going to keep just being able to pump in the money and buying up the corporate bonds and the federal bonds. Like, it's just not going to be able to do that in forever, to be able to buy all these treasuries. But they could be doing it for quite a while longer. I mean, it seems like they can do it longer than we ever imagined they can do it, right?
Yep.
We could actually see this V-shaped recovery if we really get that breakthrough vaccine or treatment, then I think you would see an explosion forward, because that would really fit the narrative of the market. And even though the fundamentals really wouldn't say that, oh, it makes so much sense, right? We get a vaccine, we get great news in the fall, and we're really able to hit this thing. You could see the stock market just shoot hard ahead, which wouldn't make a whole lot of fundamental sense, but it would fit into the narrative, and all that momentum behind it would just accelerate forward.
Excellent. Lenore, we're well over our time slot. I appreciate you being generous with your time here today. Good luck with your travels back to the United States. Does this mean next time we're speaking, you're in the US?
Hopefully. We'll see if I get there.
Awesome. Well, thank you so much for coming on, and travel safe.
Thanks, Jay.